Welcome to the IRS Debt and Audit Podcast with Brian Loughrin.
Hey everybody, welcome to the IRS Debt and Audit Podcast with Brian Loughrin. I'm your host, Mike Leon. You know, Brian's a veteran tax attorney with over 25 years of experience helping individuals and business owners resolve serious IRS problems. He's admitted before the U.S. Tax Court, and he represents clients nationwide in audits, debt resolution, and federal tax disputes. You know, in today's episode, we're going to talk about something that's kind of near and dear to my heart. It's a wake-up call for anybody dealing with tax debt. What can the IRS take? Besides money, what else can they take? Is there anything else? We're going to find out from Brian in just a second. If you think they're only looking at your bank account, think again. And Brian's going to explain why in just a second. So, Brian, when people think of IRS collections, they usually picture like these bank levies or taking money. But can the IRS go after much more than that?
Hey, Mike, thanks for having me. They can. They can take virtually any type of property, and they can take it when it's held outside of what I'd call the normal channels of ownership, certain types of trusts, just ways people will move monies around or assets around. And when I say assets, there's financial assets, which is really liquid money. And then there's physical assets. And then there's financial assets that are a little more difficult for the IRS to get to. But, you know, the IRS has been in business for 100 years plus. There's a lot of very smart people that work there. Maybe some not so smart. It's like anything else, and they've been doing this a long time. And there's no secret angle or secret way to put assets to prevent the IRS from getting them. Some assets are protected, and it has to do sometimes with just the economic situation that someone is in. Obviously, certain types of assets that are for very specific medical reasons and that. But those really aren't the kind of people that find themselves at the IRS knocking on the front door wanting to take what they have. But the IRS can take things such as homes, land, automobiles, jewelry, and so forth. But here's the thing. I tell people this. The IRS is in the cash money collection business. Okay? They don't want your house. They don't want your car. They're not Century 21. They're not Remax. They're not CarMax. They don't want your golf clubs. They don't want your wife's jewelry. They don't want your dog's water dish. Okay? They want cash. At which point people say, well, good luck, because I don't have any. That's why I'm on the phone with you. And I say, well, do you work? Well, yeah, I work. I mean, of course, I have a job and so forth. They say, well, then you have an income, and that's money. That's cash. And they say, well, I need that to live on. And I say, well, you and everybody. I mean, everybody needs money to live on and their income to live on. I mean, even very wealthy people don't just live off the money in the bank, they live off an income. So the IRS doesn't want to take those things. They would rather have the cash, but in certain instances, yeah, they will take assets. Yeah. But the thing is this, the IRS has a few auction websites. So if you go to the IRS website and you look at their auctions, what I tell people is this, when you see the kinds of homes and land that they seize and the kind of cars, the kind of homes they're taking are maybe luxury homes or luxury condominiums in big cities, or maybe 600 acres in the Tennessee mountain where some moonshiner was doing his business. As far as cars, it's maybe a Bentley or maybe a Rolls Royce or some Corvettes or things. And I always say you're never going to see a Toyota Camry on the IRS website. I mean, they're not interested in taking just a regular person car. They will take luxury items, but that's almost always tied to a situation where somebody's involvement with the IRS goes far beyond just having a debt. There are people that have debts with the IRS as a result of criminal activity. People ranging everything from people involved in drug dealing to counterfeiting and everything in between. So generally speaking, those types of assets like cars and land and so forth, that's usually a result of something like that. But no, they're not interested in your things. They want cash money.
Well, it's good to know the Callaway golf clubs are safe for me right now, Brian. So, but let's pick apart a couple of the things that you said there. So let's talk about wages first, because obviously you said they want the cash money records here. So if they want to take the wages and they do a wage garnishment at your job when it comes from the IRS, how much can they actually take from that?
On average, it's about 90% of your take-home pay. And so, I mean, I don't know anybody that would be able to get by on that. And I don't know anybody that would want to continue to work at 10% of what they were making the week before. And also, many of these people have good jobs. They don't want to just quit their job. It's not like they're making $3 an hour and they can just go across the street and make the same amount across the street. So it's a very startling proposition. But the thing is this: you really have to go a long way with the IRS before they'll issue a wage garnishment. And that doesn't mean if they issue a wage garnishment, there's no hope. That's not true. I mean, we have to, any type of wage garnishment like that is something that can be released. In some cases the same day, some cases a couple of days, a week, or whatever. So there's many instances where we've gotten involved and we've prevented the wage garnishment from ever going on the person's next pay cycle. But that'll be about 90%. And if you are a 1099 worker, meaning that you're an independent contractor and they don't take out any taxes, if a garnishment comes through like that, it's 100%. 100%. And I mentioned before in another episode, I've never seen a business that received notice of a wage garnishment or some type of levy that ignored it. They will follow through and they will adhere to what the IRS wants instantly, far ahead of anybody that's been there a long time. It's nothing personal, but the business doesn't want to get on the wrong side of the IRS, believe me.
So let's go to the second part, because you were mentioning about seizing property, home, other things, items like that. First, how often do they actually do it? And then the second part is, like you said, it was more of like luxury items that are normally taken. You're never going to see a Toyota Camry on there. So someone that's listening to this is like, okay, so they won't take my stuff. How does it work?
Well, here's the thing. Most people, when it gets to this point, and again, we're talking amounts that are, we'll say tens of thousands and above, and sometimes 6 figures, 7 figures. Oftentimes those people, if they own a home, they have quite a bit of equity in the home. So the IRS is looking at that and they're saying, well, let's just size it up. You owe us, and I'll use simple rounded numbers. You owe us $300,000. And while you don't have a lot of other financial assets and we don't want your car or golf clubs or your dog's water dish or your wife's wedding ring, we're not interested in that. We need to see what you're able to pay. Well, oftentimes these people have equity in the home. So the IRS will look at that equity and they'll say, well, squeeze out the equity and give it to us. And the person says, well, see, my home is valued at $700,000. I owe, $300,000 on it. I have $400,000 equity in the home. And the IRS says, is great. Go ahead and borrow against that, pay us what you owe us, and then we'll leave you alone. And a lot of people say, well, I don't really want to do that. I don't want to secure a higher mortgage. And then the IRS comes back and says, well, if that's the case, then we can take your home. We can seize your home. That's what they say. But in reality, they don't really want to do that for two reasons. One, there's an existing mortgage, and the IRS doesn't really want to get involved in an asset unless it's a hella big asset, like millions. They don't want to get in the middle of it if there's already an existing creditor on part of that asset. The other thing is for the IRS to seize a personal residence, and I'm not talking about somebody that has rental properties, commercial rental properties, or they own a bunch of houses they rent out. And I'm not talking about people in the real estate business, but I'm talking about the average person that we deal with. The IRS, for them to seize your house, they have to go through and file a separate lawsuit in federal court, and it's a lot of work. And then ultimately on the backside of that house is going to go up for auction. So if you tell me your house is worth $700,000 on the market, Zillow says it's worth $700,000. Well, if it goes to auction, I think everybody knows it's not going to sell at top retail dollar. It's going to go at maybe 50 cents on the dollar. So the IRS is saying, well, gosh, if we do all that, go to court, win the case, fight the appeals and so forth, on the backside, we sell this thing for half of what it's worth. And they start looking at the numbers and they realize it's not going to be worth it. And that's not to say you just thumb your nose at them, but just keep in mind that generally speaking, they don't want to go through that. And if you contact our office, we can find ways to work with you and with the IRS to bring about some formal resolution that's going to be acceptable to the IRS, but at the same time reasonable and livable for you.
Brian, let's talk about, so we talked about wage garnishment. We talked about assets. Let's talk about some of these other savings accounts, 401ks, IRAs. We've heard of people losing Social Security checks, military benefits. Can any of those things be touched, or are they absolved from IRS collection? How does it work around those?
Starts getting fine line, but you look at certain, I would consider, like say, for instance, military disability pay. Somebody's on a full military disability. That's the kind of thing the IRS isn't going to touch. I mean, that's just for a couple reasons. In many instances, there are some laws that protect it, but keep in mind, the IRS isn't a real popular entity Of course, you're never going to hear me say on this podcast or otherwise that they're the devil or they're evil or they're greedy. I mean, they are what they are. They're the financial collection arm for the United States of America, the largest economic entity in the history of the world. You got to have some vehicle. Where I get a little bit sideways is sometimes how they go about it. So when you're looking at other types of financial accounts like 401k, retirement plans, and so forth, it takes a few layers of the collection process to get into that. Um, and especially for people that are much younger. But if I have somebody that's 61 years old and they are not really able to work anymore, say just physically, they just don't have the ability to do what they do, and they have a retirement account that they're literally going to live off of. I've had a lot of situations where the IRS has talked about taking that, but realistically, it hasn't happened. At least it hasn't happened to my clients that I've represented. So there's a lot of detail that can go into it, but as I said earlier, there's no magic way to stash your money where the IRS can't get to it. I get people calling and saying, I'm going to create a trust and put it in a trust and the IRS can't touch it. And I say, oh, great, man. When you do that, let me know what it is. Because I've been doing this 25 years. I'd love to find out what it is and tell my clients. They said, what? I said, listen, there's no magic vehicle like that. If there was, everybody would do it, right? Why wouldn't they? But again, it's you just have to look at the type of asset. More than anything, as I say, they're more interested in the income end of it, which is really the most challenging part for our clients, because the IRS says, well, give us part of your income. Well, part of your income to them is a lot more than what part of the income is to you, because if you leave it to the IRS to tell you how much they're going to take every month, I can assure you it's an amount far greater than what you think you need to continue to live on.
Brian, what role does timing kind of play here? Because there's obviously a process. The IRS has to follow it before they start seizing property, before they start doing wage garnishments. Can you kind of take us into like what role does timing play in all of this?
Well, remember, everything with the IRS has to be issued through some type of notice. And generally, the notice is going to be a letter sent to the taxpayer's most recent address. And that's almost always the address on the last filed tax return. Or if you have filed and then you move shortly thereafter and you do a separate change of address with the IRS. They have a form on their website that you have to fill out and paper mail in. It doesn't work to just go to the post office, but they will send notice after notice after notice. And when people call and say, I just got this letter, I'm concerned, what can I do? I say, well, do you have it there? Yes, I do. Well, at the top right corner, it's got a number, CP something or LTR. Tell me what it is. And when they tell me what that notice number is, I know in the collections process where it is. And they'll send an initial notice on a debt, and then they'll say, contact us. Then they'll send a second notice that says, hey, we already sent you a notice. We didn't hear from you. Then they'll send you a third notice that says, basically, we're kind of getting pissed. And then they'll send you another notice, which is usually 30 to 60 days after that, which says, we're really getting mad at you, and here's what we can do. And then that's when you start rolling into the situation where they might file some type of a tax lien. But again, just ignoring them isn't going to do any good. So when people contact us, the first thing we do is we reach out to the IRS. We secure some type of hold on collections, at least to the point where we can go ahead and start moving to put something in place. But you do have a certain time frame, 30, 60, 90, 120 days. That's not to say you should wait to the last minute, but it's not instantaneous. That first notice doesn't mean they're going to send somebody to your house, even if it's a very large tax debt, say 6 figures. They don't move that quickly, and they don't really have the resources to send people out that quickly. But don't ignore it. Don't sit there and wait till it gets to the point where you can't sleep and finally say, I've got to do something, because the sooner you tackle it, the easier it is to resolve.
All right. So can the IRS, they've started taking action already on me. Can I negotiate a payment plan after this? Or like I've heard about these offer and compromise letters that sometimes you get. Is it too late at that point if they've already started to take action?
No, it's not. But once they've kind of sunk their claws into a paycheck, garnishment through wage or accounts receivable levy, they're not as quick to want to move forward on something like that as if they would be beforehand. It's why I said earlier, just don't wait till it gets to that point. But yes, you can go ahead and put something in place. And it may be, as you said, Mike, like an offer and compromise, which is probably the thing that most people are familiar with. And that's because there are a lot of companies out there that advertise television and radio and so forth, the pennies on the dollar, settle your debt, 10 cents on the dollar and so forth. And that's a whole nother story there. But the reality with an offer in compromise is, yes, they will take a much smaller percentage as satisfaction for the debt. But the key is you have to qualify for it. It's not enough to just want it or ask for it. Um, it's kind of like food stamps. If you want food stamps, you're at the grocery store and somebody's checking out a big cart full of groceries and they hand over, the EBT card or whatever. You're like, well, that's great. And you go to the office, say, hey, I want to get one of those. And they say, well, let me ask you some questions. And do you work? How much is your income? Do you have minor children? They say, well, sir, you don't qualify. It's not enough to want it. You have to qualify. When it comes to some type of a payment plan, or what's formally referred to as an installment agreement, in most cases, the vast majority of people, 90+%, are going to qualify for some type of payment plan. It's never a question of, will the IRS take a payment? They most often will. That's not the question. The question is, how much of a payment? And if you leave it to them to tell you how much of a payment versus how much you think you can afford, I got news for you. It's going to be a big different number, and it's not to your advantage. See, at its core, the IRS's job is to collect the money as much as they can, as fast as they can. That's what they're there for. And that's just the way it is. It's not evil. It's not wrong. It's just what they're to do. But the thing is, we know what they can and can't do under the tax code. And most people who handle it on their own, they don't. And one thing I hear quite often from people that have kind of taken steps on their own, because a lot of our clients are pretty sharp people, educated professionals, accomplished people. I say, well, I called the IRS and I got this lady on the phone and she was real friendly. She's really nice. I said, well, yeah, because she's trying to get money out of you. Of course she's friendly. She's going to, get after you, call your names on the phone, and they want to get money. But the thing is this. You didn't tell her where you bank yet, did you? And you didn't tell her where you work, and you didn't tell her this, that, the other thing. So, well, yeah, we went through all of that. I said, well, now they know how to go after you. And I said, if I'd have called in, it would have been handled much differently. And that's not to say you don't have to disclose that information ultimately, but sometimes it's how you disclose it. And one thing about the IRS is this, both with collections and really in some cases even more so in audits. Sometimes how you present the information can be as important as the actual information itself. If you think about it, say, facts are facts. Where I bank, where I work, equity in this, and so forth. Well, the facts aren't going to change. But sometimes how you approach it can make a big difference because the IRS is made up of people. And some people are easier to deal with, some people more difficult. But ultimately, it's people-to-people dealings. I heard an interesting story one time. It started out years ago, and a revenue officer is a collection agent for the IRS. Revenue officer, like a police officer. Revenue agents are auditors or accountants. This revenue officer was an older guy, and he told me when I met him, he says, well, I'm getting ready to retire here in the next year or two or something like that. Oh, okay, and I went around with the guy, and he was a super friendly guy, real grandfatherly like, and just a great guy. And man, he was hard to deal with. I'm gonna tell you. That guy, he was no pushover, and we kind of butted heads and stuff. But eventually, I dealt with him on a bunch of cases. He was a good guy, but he had a job to do, and I respected it. And I'll never forget, I ran into him about 2 years down the road, and I said, "Hey, what are you doing? I thought you were going to retire." He says, "Oh, they won't let me. They got me training all these young pups, all these young new revenue officers." And I guess this about 15 years ago. And I said, "Oh, wow, okay," and so forth. I said, "How's that going?" He goes, "Oh, it's pretty interesting." He says, I got in a car just the other day with a brand new hire, and I told this, it was a lady, says, I told her, you go ahead and drive. And we were going to drive out to this client's house because he wasn't responding to the letters and notices and so forth. And we were going to go ring his doorbell and talk to him. And we started to drive out there. And he says, as soon as we started, I reached over and I said, stop. And she stopped, said, what's going on? She's young and nervous. He says, so what business are we in? And she says, well, we're in the IRS tax collection business. And he says, no, we're in the people business.
Right.
She just looked ahead and she just drove. And so what I tell clients is this, there's a huge human component to doing this kind of tax work. And it's not just all computerized, because guys, if it was, you wouldn't need a lawyer and you wouldn't need revenue officers or revenue agents. You just type all the information in a computer, hit the send button, and have your answer. And so, again, it's very important to understand how you go about things with the IRS, and the timing and moving after it as quickly as possible is only going to be to your benefit in the long run.
So then let me ask you this, because we talked about this in a previous episode and you mentioned the word lien here with respect to tax liens. Can you explain a little bit more difference between lien, levy, and when it comes to your property being at risk?
Well, a lien is, as I said earlier, it's a representation of debt. It means that it is a reflection of what you owe. And one point about liens is when they are filed, they're filed one time, and that's the amount of debt at the time it's filed. So I've had people come to me and they say, well, I just found out I have this lien on my house and so forth. And that's not uncommon. And I say, well, let me look at it. And I say, well, I look at it. I says, this thing was filed 5 years ago. And they say, yeah, see, it says on there that I owe, $77,000. And I said, okay, well, have you paid on it? And they say, no, I haven't paid anything on it. I said, okay, because the lien amount now is much greater because they charge interest and they charge penalty. And they say, well, how come it says? I said, because they don't update it. It's not like getting a credit card statement that's updated once a month or even an annual statement. They keep it at the same amount. As far as a levy, when they do exercise a levy, and it's always off some type of a lien, it's a situation where it's going to be the amount due at that time, at that particular day, not necessarily what it was at the time that the lien was filed. So if you have a situation where you're working with an older lien, just keep in mind, unless you've paid on it, that amount is probably increased.
Brian, let me ask you right now, someone's watching this, they're listening to this, they're scared. You've scared them straight here about what the IRS may take if it's something important. What should they do right now to protect themselves in your advice?
Well, first thing is don't call the IRS. Okay, it says on the letter, call this number, talk to us, and so forth. And folks, I'm not talking about somebody that owes a debt of, let's just say, $3,600. Okay, and that's presupposing they're not indigent. Okay, it's somebody making, whatever, enough money that they could space out a debt like that over a period of time. Okay, and over a couple of years or something. I'm not talking about loan things. I'm talking about people owing tens of thousands or more. And don't call the IRS. They're not there to help you. And people say, well, I called and they were real friendly. I said, listen, man, they may be friendly, but they ain't your friend. Okay. They're there to collect as much money as they can, as fast as they can. That doesn't make them evil or bad people. That's what they're to do. Unless you want to just open up your wallet and give all the money you have to the IRS, go for it. You don't need me. But if you want to take a measured approach, call our office. Because I will say one other thing about these notices. It's always been kind of a presuppose that these amounts are accurate. And there are times where people get notices, liens and things like that, and even cases levies, and they say that this isn't right. This can't be right. I mean, something's been mixed up. And I see cases, and it's not that common, but I see cases where people are assessed or given a tax balance that's not theirs for various reasons. And that kind of gets more into some of the audit. But one of the first things we do before we take any steps trying to settle, or when I say settle, resolve a debt in a formal resolution, is I want to confirm that the balances that the IRS says are owed are accurate. I'm not just going to run with their numbers and go, well, this is what you owe. I'm going to say, well, wait a minute, man. I want to look at the returns. I want to look at the account transcripts. I'm going to look at the master file. There's all kinds of things I want to look at before I just take the next step moving forward. And in most cases, they're accurate numbers. But in those cases they aren't. It's very important that you don't just plow ahead and contact the IRS, because they're very, very good about getting the information they need to enforce collections. And you definitely can avoid that by contacting them. And if somehow the IRS puts somebody individually on your case, somebody from a local office who sends a letter, all the more reason to call, because of all the cases that the IRS has, collection cases. I don't know what the exact percentage is because the IRS is pretty tight-lipped about it. But I would have to imagine it's probably really under 10% of the total cases out there are assigned to local revenue officers. And if they're assigned to a local revenue officer, that means it's like a detective on the TV show. He's looking into this crime. He's coming by your house or your work or whatever. The guy ain't going to just stop, okay, until you talk to him or do something. It ain't going to happen. Same thing. If they put a revenue officer on your case, they're not just going to go away and go, I'm tired of chasing this guy. It ain't going to happen. Okay, they're gonna keep going at it. So definitely, if there's a local revenue officer assigned to your case, all the more reason to reach out to us. And we do provide a free consultation.
There you go. Thank you so much for the time and insights on this, Brian. We truly appreciate it.
Thank you very much, Mike.
And thank you out there for listening to this episode of the IRS Debt and Audit Podcast. If you're facing aggressive IRS action or you're worried about losing your income or property, you heard what Brian just said. Don't wait. Visit tampataxrelief.com. Schedule a free consultation with Brian and the team. They can help you understand your rights and fight back legally and effectively. As always, be sure to subscribe to this episode, leave a review, like, comment, share with whoever may need it. As always, I'm Mike Leon. We'll see everybody next time.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.